As fears of a recession increase, alternative investments seem to have been making waves in the financial world. Probably you've come across some of these articles, emails, or ads about them. Maybe you've heard your friends or coworkers talking about them as well. So in this video, we're going to unravel the mystery behind alternative investments, what all the fuss is about, why they matter, perhaps more than ever. So grab your favorite drink, sit back, and let's get started. Before we jump in though, if we haven't met, my name's Steve Willems. I'm one of the wealth advisors here at the Willems Wealth Planning Group. We help people like you make better decisions about your money, both as you approach retirement and then on the journey after retirement as you're working your way through that as well. Make sure you hit that subscribe button and hit the notification bell so you never miss any of our upcoming videos. And with that, let's dive right in. So what exactly are alternative investments? Well, simply put, they're any kind of investment that falls outside of traditional categories of stocks, bonds, and cash. Think of them like the rebels of the investment world. Some examples of alternative investments might include real estate, flow-through shares, commodities, private equity, infrastructure holdings, arts, collectibles, cryptocurrency, maybe even lending. These assets have been around for quite some time, but what's interesting is that they're gaining popularity among regular retail investors like you and me, not just the super wealthy where they were typically constrained to in the past. In fact, according to a report by PwC, alternative asset investment is projected to grow from about $10.7 trillion in 2020 to a whopping $24 trillion by 2025. That's some pretty meaningful growth. And whether you know it or not, you actually already have exposure to these types of alternative investments. The Canada Pension Plan, based on their 2023 annual report, shared that the base CPP pool of $570 billion already had about a 9% allocation to infrastructure, a 9% allocation to real estate, and a 33% allocation to private equities or privately held businesses. Add that up, that's 51% or so of their total assets, which could be considered in this alternative bucket. Now you may be wondering, why all the excitement? Why are they doing this? Well, there are two main reasons. First, alternative investments can offer a higher return potential compared to traditional investments. Since many alternative assets are based in growing, perhaps inefficient markets, they sometimes deliver higher returns than traditional assets. And who doesn't want to maximize their returns, right? Second, alternative investments often have a lower correlation to public stock markets. They behave differently and may experience less loss or volatility during economic downturns. This means that they can provide often a hedge against public market turbulence and offer perhaps stability when you might feel like you might need it the most. Often this comes as a result of these assets just being harder to price. In most cases, price is determined when a buyer and a seller can agree and shake hands on a value. Think, as an example, about your home. It doesn't matter what the price is listed at. The only price that matters is the price that someone else agrees to pay. Well, for many of the assets in this alternative space, the ability to quickly and accurately price these holdings, businesses, real estate, collectibles, whatever they may be, it's often more challenging. Not only can these show as sometimes being uncorrelated then, but also perhaps smoother because the prices don't change every single second of the day. However, it's important to acknowledge that alternative investments aren't all sunshine and rainbows and roses. They come with their fair share of risks and drawbacks. One, for instance, they often require larger minimum investment sizes, which might be a barrier for some investors. Often in Canada, many of these strategies might only be available for accredited investors who meet certain income or asset thresholds. They may also limit access to your money, as certain alternative assets can have what are called lockup periods. For example, if a strategy is involved in developing real estate properties, adding value by entitling or rezoning a property, a building, or selling the space, it's reasonable that an asset and a strategy like that can't really quickly be liquidated. And so there's this lockup period. You can't ask for your money back within a certain time frame. Additionally, alternative investments tend to have more complex risk profiles that require careful consideration. It's also important to remember that many people successfully reach their retirement goals without even using alternative investments even to begin with. So it's not certainly a one-size-fits-all approach. This needs to be right for your situation, and you have to at least be qualifying for these strategies to begin with. So here's the bottom line. Alternative investments can certainly be a valuable part of a well-diversified portfolio. They're growing in popularity. They offer the potential for higher returns and can provide stability during uncertain times. But, and this is a big but, they should only be added as a part of a comprehensive investment strategy. It's essential to consider your financial goals, risk tolerance, time horizon before incorporating any of these strategies. It all has to work together. If you'd like personalized guidance on if or how this might look in your specific investment strategy, I'm here to help. Let's start a conversation. That's a wrap for today. I hope you found this deep dive into alternative assets helpful. If you did, give the video a thumbs up and share it with your fellow friends. As always, if you have any questions or topics that you'd like us to cover in future videos, leave it in the comments below. Until next time, take care.